U.S. factories are coming back, and so are industrial stocks. For the first time in decades, America's manufacturing base is expanding rather than shrinking. You can see it in construction data, corporate earnings, and the boom in reshoring announcements from companies that once chased cheaper labor overseas. Today, we'll unpack the new manufacturing renaissance, what's driving it, which stocks are already cashing in, and how investors can position through industrial ETFs like XLI and PPA. Segment A, the policy backdrop, why onshoring is real this time. For years, politicians talked about bringing manufacturing jobs back home, but only now are the numbers showing it's actually happening. According to the Bureau of Economic Analysis, U.S. manufacturing construction spending has tripled since 2019. What's behind that? Three big drivers. First, policy incentives. The 2021 Infrastructure Investment and Jobs Act committed over $1 trillion to rebuild roads, bridges, railways, and power grids. Then came the CHIPS and Science Act, offering $52 billion in subsidies to chip makers building domestic fabs. And finally, the Inflation Reduction Act added hundreds of billions in clean energy tax credits for everything from battery plants to EV supply chains. Together, these laws created what economists are calling a manufacturing supercycle. It's a policy trifecta designed to reindustrialize the U.S., and it's already reshaping capital spending decisions. Second, tariffs and geopolitics. Trade tensions with China and supply chain shocks during COVID exposed how fragile global production had become. As tariffs on imported steel, aluminum, and tech components rose, many firms started hedging their risk by bringing operations closer to home. Mexico, too, has benefited under this nearshoring theme, but U.S. manufacturing hubs in Texas, Ohio, and Arizona are leading the charge. And third, technology. Automation, robotics, and advanced materials are making it cheaper to produce locally. The old argument that U.S. labor was too expensive doesn't carry the same weight when factories are run by robots and data analytics instead of cheap overseas hands. Put it all together and you get a macro environment that strongly favors companies tied to industrial equipment, energy systems, and construction infrastructure. Segment A, stock pick number 1, Caterpillar, ticker CAT. Let's start with an old-school name thriving in this new era. Caterpillar is the world's largest maker of construction and mining equipment. When you think about bulldozers, excavators, and heavy machinery, that's Caterpillar's domain. The stock has quietly become one of Wall Street's favorite industrial plays, rising over 70% since early 2023. Why? Because every major policy initiative, from infrastructure spending to data center construction, requires Caterpillar's equipment. A single semiconductor fabrication plant, for instance, can involve millions of cubic yards of earthwork and months of grading and foundation work. That's Caterpillar's bread and butter. On the financial side, the company's margins have expanded significantly. In 2024, operating profit per share grew over 40% year over year thanks to price increases and efficient cost control. Caterpillar has also been aggressively buying back shares, reducing its float by nearly 10% over the past 2 years. And unlike many cyclical peers, Caterpillar benefits from aftermarket services, maintenance, parts, and digital monitoring systems that generate recurring revenue. It's not just selling machines anymore. It's building an ecosystem of connected equipment that improves uptime for customers. Bottom line, Caterpillar is both a cyclical and structural winner of the onshoring wave. Segment C, stock pick number 2, Eaton Corporation, ticker ETN. Next up, Eaton, the electrical systems powerhouse that's quietly become one of the biggest beneficiaries of grid modernization and factory electrification. Eaton makes power management products, everything from circuit breakers and power converters to electric vehicle charging gear. And as factories modernize, they need more efficient energy systems, smarter grids, and backup infrastructure. Think of Eaton as a picks and shovels play on industrial electrification. In 2024, Eaton sales hit a record high, with demand for its electrical components growing more than 15% annually. The company's order backlog remains near all-time highs, a sign that the industrial power market is running hot. What's more, Eaton is deeply tied to the energy transition. Factory facilities are now integrating solar panels, battery storage, and EV fleets, and Eaton supplies the gear that keeps all of it running safely and efficiently. From an investor perspective, the company also scores well on consistency. Eaton has grown earnings every year for the past decade and currently boasts an operating margin north of 20%. The dividend yield sits around 1.4% with steady annual hikes. For anyone betting on the long-term electrification of America's industrial base, Eaton is a cornerstone holding. Segment D, stock pick number 3, Illinois Tools Works, or ITW. Now let's talk about a quieter but equally powerful name, Illinois Tools Works, or ITW. Unlike Caterpillar's heavy equipment or Eaton's energy systems, ITW focuses on industrial components, fasteners, adhesives, automotive parts, welding gear, and specialty coatings. What makes ITW special is its business model, something called the 80-20 strategy. The company focuses on its top 20% of customers that generate 80% of the profit, while continually pruning less profitable segments. That laser focus on efficiency has turned ITW into one of the most consistently profitable industrial firms in the U.S. Even during economic slowdowns, ITW keeps margins above 20%. In 2024, it generated $16 billion in revenue and over $3 billion in free cash flow, which it used to fund dividends and buybacks. While a company isn't as flashy as AI or EV stocks, it's a dividend powerhouse. ITW has increased its payout for over 50 consecutive years, making it a dividend king. As factories expand and construction rebounds, ITW's portfolio of essential components, adhesives, fasteners, and tooling ensures it captures steady business across multiple industries. Bonus pick, Generac Holdings, ticker GNRC. If you want a smaller cap angle on the manufacturing revival, Generac Holdings deserves a look. Generac is best known for its home backup generators, but its real growth story lies in industrial power systems. As factories become more digital and automated, downtime is simply unacceptable. Every new data center, manufacturing line, or logistics hub now demands reliable backup energy, and Generac provides it. In addition, the company is expanding into clean energy storage and grid services, positioning itself for the distributed power future. Generac stock has been volatile, but analysts see upside as manufacturing and data center construction accelerate. For investors comfortable with mid-cap growth, it's a compelling complement to the larger names like Caterpillar or Eaton. Segment E, playing it broad, industrial ETFs. If you prefer not to pick individual stocks, you can still play the manufacturing renaissance through industrial ETFs. The Industrial Select Sector SPDR Fund, ticker XLI, is the most popular. It holds major players like Caterpillar, Honeywell, Raytheon, and Eaton. It's a diversified bet on U.S. industrial growth with a reasonable 0.10% expense ratio. Another interesting fund is the Invesco Aerospace and Defense ETF, ticker PPA. While it focuses on defense contractors, many of its holdings overlap with the reshoring and infrastructure themes, especially those benefiting from increased government contracts and domestic manufacturing of critical technologies. For a more tech-industrial blend, some investors also look at Robo, focused on robotics, or FARK, focused on U.S. energy infrastructure. These ETFs offer an easy way to capture the manufacturing boom without having to pick winners and losers, ideal for long-term investors who believe the trend will unfold over the next decade. Closing thoughts. After decades of offshoring and outsourcing, America's factories are humming again. It's not nostalgia, it's economics, policy, and technology aligning in a rare moment of opportunity. Caterpillar powers the heavy machinery behind new construction. Eaton electrifies it, and ITW supplies the nuts and bolts that hold it all together. An engine Generac ensures the power never goes out. Add in the ETF layer for diversified exposure, and you've got a playbook for the manufacturing renaissance. This isn't a short-term trade. It's a long-cycle shift that could reshape industrial investing for the next 10 years.